So let's start the new chapter, that is residence and scope of total income. This chapter is also called as residential status. Okay, so many refer this chapter as residential status, but the actual name is residence, and it also deals with something called scope of total income. Now, if you recollect the first chapter where we discussed charging section, every person whose total income exceeds, the minimum amount not chargeable to tax, we call it as basic exemption limit, is liable to pay tax at the rates specified in the relevant finance act. This is what we learned in the charging section. So every person whose total income, now they use the word whose total income. What do you mean by total income? We have already understood that total income means sum of 5 categories, 5 heads of incomes, all that. Now, here I am not, that is what total income comprises of. But what is the scope of total income? When do in income tax, if you are earning an income, comes within the scope of total income? I told you total income means taxable income indirectly. So when under income tax law, a particular income earned by any person comes within its scope of total income, which means if an income comes within the scope of total income, it is taxable. If an income is not coming within the scope of total income, it is not taxable. The tax law will not apply. So now what is that comes within the scope of total income? What will not come within the scope of total income? First, we need to understand in this chapter, we have covered that point under part number 2. In this chapter we split it into 4 parts. Part 2, scope of total income. So that part deals with this. Now just straight away let me open that and then discuss about the different taxations across the world. Now part 2, you see, scope of total income. Now how the scope of total income is decided? In this chapter, one thing that we learn is scope of total income and how to determine residential status. This is something which we learn. First, understand, income tax is something not just levied by Indian government. Yes or no? Income tax is not specific to our country alone. Income tax is levied by every country almost on their, depending upon the scope of total income defined in that country. In India, scope of total income is defined in our income tax law section number 5. Likewise, in United States also they have some regulation, okay, like revenue related, tax related regulations they have. So they will also have something called scope of total income. What incomes the United States will tax, what incomes the European Union will tax, what incomes that China will tax, what incomes that Japan will tax. So they also have their own definitions. Essentially, ideally, every country taxes depending upon the source rule. Every country taxes an income if source is in that country. Suppose a non-resident is there, a foreign individual is there. He came to India on a tour. He visited India on a tour. Now he is recording almost all the tourist places in India and publishing it in the YouTube channel and getting revenue. Getting it? Now tell me, now because he is recording every tourist place that is there in India and playing it on the YouTube, and many across the world people are watching it. Yes or no? And he is getting some income from the YouTube. Because YouTube, plays ads, that advertisement related income, some percentage will be shared with the channel owner. Yes or no? So this fellow has monetized it and he is getting some income. Now this fellow is first of all not an Indian citizen. He just came to India for a particular tour, for a visit, and out of this thing he is recording. Ignore FEMA regulations, all that, whether he can do all this or not. Let us look at it. Let us look at legalities later. But he's getting income. Now tell me, this fellow, whoever is not a citizen, is earning income because of the recording, video recordings and presentation through the YouTube of tourist places situated in India. Because of the Indian assets, this fellow is getting income, correct? Obviously, tell me, will our government ask him tax or not? Yes. Yes, sir, obviously, because he's getting income because of the tourist places that were situated in India. He's earning income in India. Obviously, he has to pay tax on it. Same way, we individuals, if at all we go to any other country and earning income in that country, if Indian income tax government is asking to pay tax on that income, Will that country agree? No. So likewise, every country will tax. Every country wants to collect tax on the income for which source is in that country. So we call it as source based principles. Most of the direct taxation are source based taxations. Most of the direct tax is source based taxation. Like, where is the source of income? If the source of income is in a particular country, that country will levy tax on that. Now, okay, source based taxation, all that is fine. Now, see, this fellow is earning income, like I told, right? Who is not an Indian citizen, he is residing in India. He just came for a visit and earning little income and he has to pay tax. Now tell me, this fellow is earning income at outside India also. This fellow is residing in some country, United States, example. So there also is getting some income. Is that income also taxable? Suppose this fellow got some YouTube revenue based on the tourist places that was there in India by recording all these videos, all that. He's getting some income. Using that income, after paying taxes to Indian government, balance income is there, no? He invested in United States itself. He bought one property in United States and he's getting rent on that property. Now, whatever income he got in India, based on that, he bought a property in the United States. Now, on that property, this fellow is getting again rent. Income on income is getting. Will that be taxable? So, now you see how many situations like this will be there. For every case, income tax department cannot sit and clarify you what is taxable, what is not taxable. No, they can't write. So, Indian income tax department divided SSCs, taxpayers, into two categories, either resident or non-resident. The department, the Income Tax Act, classified the SSCs, taxpayers, into two categories, residents and non-residents. When non-residents has to pay tax, to Indian government, getting it? Non-resident means what? He is not residing in India. He is not residing in India. He is a non-resident. Resident means what? He is residing in India. Simple logic. Resident means he is residing in India. That's it. Able to understand? Don't conclude. I'm just giving you for a basic, simple. I'm just making you to understand simply why are we learning this chapter. Same way in United States also, they have a similar terminology. Every US citizen in United States is by default a resident in US. As per US tax law, he is a resident. Now, other than US citizen, how they were called as? Aliens. Yes. In United States, under the taxation law, any person who is not a US citizen is called as an alien. Now, how aliens are taxed in United States? Nothing but how foreign citizens are taxed in United States. They also have some rules. Getting it? So, for residents, for US citizens, what is the taxation principle? For aliens, what is the taxation principles? Again, aliens can be two types, resident or non-resident. US citizen is always resident. Aliens can be either resident or non-resident. Like that in United States also they have a rule. In India, how we classified straight away, we did not classify Indian citizen, foreign citizen. No, we straight away classified into two categories. Whether you are Indian citizen, foreign citizen, doesn't matter. We in India, we classify them into two categories mainly, resident and non-resident. What is it? Resident and non-resident. There is another classification which is there. Ordinarily resident. What is it? Ordinarily resident. Ordinarily residential status means what? Like now residential status means generally resident and non-resident. For individuals and HUF. For individuals and HUF, we have two more classifications inside resident. In India, for individuals and HUF type of SSCs, we have two more classifications: ordinarily resident, not ordinarily resident. What is it? Ordinarily resident, not ordinarily resident. Sir, what do you mean by resident? What do you mean by ordinarily resident, not ordinarily resident, non-resident? We will discuss this terminology later. Now, first of all, if you are a non-resident, you are not residing in India, but you came to India temporarily just for visit, what incomes are taxable to you? If you are a non-resident, you are not residing in India anymore, you may be Indian citizen, you got job abroad and you left India for employment and earning income so much, okay, outside, and you are buying properties in India and earning rental income, earning dividend income from shares purchased in Indian companies. Like that, you are earning so many incomes, even though you are a non-resident, but you are earning income from India, source of income is in India. Obviously, Indian income tax department will ask tax on that. So, non-resident, what incomes are taxable? You are a resident, but not ordinarily resident. You are a resident, but not ordinarily resident. You are a resident, and ordinarily also you are a resident. You are a resident, you are staying in India, and ordinarily you stay in India only. You are a resident, you are a resident, you are staying in India, and ordinarily, generally, where do you stay? In the recent, just a few days back also you stayed in India. Example, ordinarily. Resident but not ordinarily resident. Resident but not ordinarily means what? He stays in India, but recently he is not staying in India. Don't worry, I'll bring all that rules, days. There is so much of discussion on this that we will discuss later. I'm just bringing you the terminology for your idea. Getting it? So we all know, you might have heard somewhere, either in CA foundation or degree or somewhere, if you're a repeater, you might have learned earlier. If an individual stays in India for 182 days, what is the rule? If an individual stays in India for 182 days in India, if he's staying in India for 182, is he Indian citizen, foreign citizen? No, that and all not required. He is a resident. Same way, in United States also there is a rule. Okay, for aliens there is a rule. If that person stays 31 days in United States, 31 days if at all he's staying in that current year in United States, in India, what is the taxation year? April to March. This previous year income will be taxable in the next assessment year. In United States, it is calendar year itself is the financial year. So for us, the financial year and calendar year are different, but for United States, the financial year and calendar year are same. Now let us first, before I start discussion into all these things, first let us look at G20 countries. Okay, what is it? Global 20 countries. G20 means it's a group of 19 countries plus European Union. European Union means almost in Europe 27 states, like Germany is a state, France is a state, Austria is a state. Like this, there are some 27 states in Europe. All these 27 states will be together treated as European Union, and that European Union plus 19 other countries including India, China, Japan. Just because these three countries, United States, of course, getting it. So these countries, 20 countries put together, they formed as a union. That's called G20. I think G20 summit is going to be happened very soon in Andhra Pradesh. Okay, G20 summit. So it was conducted earlier, and every time some one country will conduct G20 meetings. Getting it? So very, very big, very powerful meeting. Now, you see how the income tax rate. This is, by the way, I'm talking about personal income tax rate. What do you mean by personal income tax rate? Normally for individuals, what is the tax rate? Personal income tax means individual related tax rate. There is something called corporate tax rate, means for companies, body corporates. You see, we generally think that India is having highest tax rate. India is charging 42.74% maximum tax on individual. How 42.74 came? How? Yeah, 30% is the maximum tax rate for individual plus 37% surcharge plus 4% is equal to 42.74%. You see, contrarily, Japan is charging 56% tax. One country with whom we always compete, China, is collecting 45% individual income tax rate. Getting it? So just G20 countries, how they are charging. Singapore, on the other hand, is charging lesser rate. Russia, lower rate of tax, 13. And Saudi Arabia is 0. So United States, the tax rate is 37%. This is the tax rate including surcharge, everything. This is a website, tradingeconomics.com is a website where you can find indicators for so many metrics. There are so many indicators, GDP, like entire all microeconomic indicators you can find. So this is income tax rate in different countries. Just wanted to show you for your better understanding. So very simple. Let me sum up. What is the purpose that we are learning? So this chapter heading, if you look at residence and scope of total income. Scope of total income, what incomes earned by any person, whoever is the person, what are the incomes that he is getting, from where he is getting, what is included in total income definition, that is explained in this chapter. Now the scope of total income is decided for any particular type of taxpayer based on residential status, and that's why we need to learn residence. So first let us learn scope of total income straight away. Okay, scope of total income. Remember, every country in this world has to follow source based taxation. Every country, okay, they have to follow source based. Let me also show you, or else I'll come to this in residential status discussion. Okay, like how in United States they divide resident, non-resident. What is the criteria? Just for a brief understanding, I'll cover this now. So now let us right away discuss the topic. The incidence of tax, the applicability of tax on any person depends upon his residential status. I cannot go and levy on a Chinese, individual. Hey, you pay income tax to Indian. Why should he pay? Am I earning any income in India? No. Immediately he'll argue this. The scope of total income of an SSC depends upon the following three important considerations. One, residential status. Another one, where are you earning this income? Where are you receiving this income? What is the time at which income is earned by you or received? So that's, one is residential status. What is the place where you are earning this income? What is the place where you are receiving this income? And when you are receiving this income? There's so many factors. See, just for explanation sake, they have used this. So that is nothing to deal with in the original section of section 5. Now what section 5 covers is this. Section 5 subsection 1 talks about resident related taxation. Section 5 subsection 1 talks about what incomes are taxable in the hands of a resident. Sir, what do you mean by resident? I told you, right? I'll cover later. First, let us understand this. Now, 5 subsection 2 of the Income Tax Act talks about what incomes are taxable in the hands of non-resident. Non-resident means, first of all, he's not staying in India. Why the hell you tax him? There are some reasons why we tax a non-resident. One reason is, example, he visiting India, earning some income in India and left country later on. So temporarily he stayed in India and earning income in India. So obviously I want to collect tax on that portion of income. So now there is a proviso. I told you in the very first chapter, what do you mean by proviso? Okay, it may be an additional condition, or it may be an exception, or it may be an additional condition come clarification. The proviso talks about ordinarily resident. The proviso talks about ordinarily resident. So before I show this table, let me show you the act itself. So Income Tax Act. So this is the official website of the Income Tax Department. So here itself it is there. Yes. So scope of total income. I told, right, this has only 2 subsections. Subsection 1. What is it saying? How to zoom this now? I just want to increase the size. Here some plus button will be there logically. Fine. Anyhow, let me be like this. Subject to provisions of this law. Okay. The total income of any previous year of a person who is a resident. You see here there is no word used. Ordinarily resident, nothing. Normally resident. The total income of a resident includes all income from whatever source, whatever you are earning, derived, which is received in India. So if you are a resident, if you are receiving any income in India, it is taxable. See, there are 2 principles. One is source principle. Another one is receipt principle. Receipt based taxation. Income tax department in India, the government will collect a tax if income source is in India. You may be receiving abroad. Suppose you have a property in India. you rented it to somebody, that fellow paid rent to your bank account situated in America. Your source is in India, but you're receiving in America. Getting it? Or you settled in India already. Earlier you worked abroad and now you came back and settled in India. Getting it? Now you are having a property in United States. There you are renting it. That fellow is paying rent directly to you, sitting in India. So you are receiving in India, but source is not in India. Source is in US. Getting it? So what is the first principle? What are they saying? What is the first principle that they're saying? If the income is received, or what is it? Deemed to be received. Income is received or deemed to be received. Sir, what do you mean by deemed to be received? Received means I understand. So somebody paid me, I received it. Means I understood. Deemed to be received means what? We have a definition for that. Section 7. What is it? Section 7 of the income tax law talks about what do you mean by deemed to be received. See, actually, deemed to be received means the income tax department assumes that you received it. Actually, you have not received. If at all you actually received it, it's a received. No. Deemed to be received means what? You have not received it. So anyhow, what is deemed to be received? We'll discuss later. So what are they saying? The resident, for a resident, the total income includes if the income is received in India, if the income is accruing or deemed to accrue or arise to him. Getting it? Accrue or arise to him outside India during that year. Now you see there are 3 points which they are saying. For a resident, income received in India, taxable. Okay. Income is accruing in India. Accruing means what? Source based. Received means receipt. Receipt based taxation. Another one is what? Source based taxation. If at all you are a repeater, if you think that you already know this provision, don't skip it. Listen from the beginning if at all you skipped and came to here. Because I am going to talk, in a very different way. Getting it? So completely where I'll be explaining you why are we learning everything. It's not like income tax, many try to mug up the subject, but it is very, very logical. Getting it? Fine. So another principle is what? Source based. So income received in India is taxable, income accrued in India is taxable. Now you see the third category, exceptional category I can say. The income is accrued. What is it? Income is accrued. Income source is outside India. Source is outside India. And you see for a resident, that is taxable. For a resident, even if the source of income is outside India, it is taxable. What are they trying to tell? As per 5 subsection 1, for residents, global income is taxable. What is it? Global income is taxable. Even if the source of income is outside India, global income is taxable. For example, sir, I am a resident in India. I am residing in India, settled in India now. Earlier, I worked in US as a software consultant and I purchased some properties in United States, immobile properties, which I am renting and I am getting rental income. Now I am a resident in India. Now what are they saying? Even though the property is outside India, you are a resident in India, right? You have to pay tax on that. That's what income tax department says. The scope of total income section 5 says what? Even though you are having property outside India, even though income is accrued outside India, even though the source is outside India, you have to pay tax in India. It is treated as total income. It is taxable in India. This is general rule. Understand, section 5 is a general rule. Now immediately you will say, sir, just now few minutes before you told, every country will have source based taxation only, Suppose a foreigner is coming to India, earning income in India, Indian income tax department will collect tax on that. Now you are saying, if a person is a resident in India, even though source is outside India, you are saying again department will collect tax. Same way, other country also may have a law, right? United States law also may be there, no? What United States law says, every resident in United States, every resident, especially US citizen, he has to pay tax on all the incomes, whether that is earned in the United States or outside the United States. There is a law in US. What US law says? Every citizen of United States has to pay tax on income that is earned in the United States or outside. Doesn't matter. Where are you earning? Doesn't matter. On every income you have to pay tax to United States. Now here there is a doubt. Sir, suppose, no, just now you told one example. Suppose I'm a citizen in India. I'm a resident in India. I have house property outside United States. United States also will say that on the property source of income is US. No, they have to pay tax. I have to pay tax to US because property is situated there. And I'm a resident in India. No, Indian government says even though the income is outside India, you have to pay tax on that income. Suppose, sir, I am getting 1 lakh rupee income example in a particular month from that property. On this 1 lakh, I have to pay tax to Indian government 30%, 40 surcharge altogether. I have to pay to United States almost 35-37%. What is left for me? Almost 80% taxes I am paying. What is left to me? That's why there is something called double taxation avoidance agreements. What is it? Double taxation avoidance agreements. Indian economy, Indian government has entered into double taxation avoidance agreements with almost all major economies in the world, including United States, China, everywhere. What they decided in DTA arrangements, these remember, these are general rules. Section 5 is a general rule. Scope of total income is a general rule. What is covered within the total income? You are a resident. Source is in India, received in India, source outside India, doesn't matter, taxable. All incomes that you are earning is taxable. Why? Because you are a resident in India. Because you are residing in India, you are benefiting from the India. Getting it? So you have to pay tax on the entire income. Same way US law also will have a law. Same way China government also have an income tax law. Same way Russia also have an income tax law. Every country will have a similar law. That's why these countries, these economies enter into double taxation avoidance arrangements. DTAA will be discussed at final level. We will discuss at final level in direct tax subject. Okay. So anyhow, I will start my direct tax subject probably after 4 or 5 months. Maybe in the 2023 ending or 24 beginning, I will start my direct tax subject. Anyhow, so there is something called double taxation avoidance. What is double taxation avoidance agreement? Indian government will talk to US. Dear US government, I have a rule called if a person becomes a resident in India, irrespective of source of income, what is it? Irrespective of source of income, I tax it. Same way, US also has a law. If a person is a citizen of United States, irrespective of source of income, whether the source is in US or outside the US, doesn't matter, they will tax it. Now, dear United States, I have a person who is a resident in India. This fellow has earlier worked in US and he is earning income in the US from a property, movable property. Now, as per my country, for non-residents, we tax only if the source is in India. For non-resident, we tax either source should be in India, or received must be in India. If either receipt or source is in India, only we tax a non-resident. So let us assume your citizen is, or else keep this aside. Let us stick with house property example. So resident is there, no. So this fellow is a non-resident for you. In US, for aliens, for non-residents, you are taxing because the source is in United States. On that income, I am taxing by calling him as a resident on the global income. Now you say the same income is taxed twice. So let us enter into an agreement. If there is a conflict between taxation, if a particular income is taxed twice under your law, under my law, let us frame one rule. Every country respects a source principle. What is it? Every country respects source principle. What is source principle? Suppose whether he is your citizen or my citizen, doesn't matter. If particular income is taxable under your law, under my law also, if the source is in your hand, you take it, I will not collect tax. Or if source is in my hand, I will take it, you don't collect tax. Like this, every country has entered into double taxation agreements with many countries. US will have double taxation avoidance agreement with major economies. India will have double taxation avoidance agreement with almost all the major economies. China will have DTA with major economies. We call them as treaty arrangements. What is it? We call them as treaty arrangements. That's it. So the double taxation avoidance agreement, international taxation, non-resident taxation, more specifically, we will discuss at CA final level. At CA Inter, we are having only a basic level. So let us very simple. Let me once again, till now I just gave you the background idea. Why are we learning residential status and what is scope of total income, all that. Okay, this video also I will put it on the YouTube as a demo video. So if at all you have any confusion on watching this first 30 minutes, once again go to YouTube channel and just search residential status here Harsha, you will find the video. Okay, fine. Now once again, what is scope of total income? As I told, we divide SSCs, taxpayers, into three categories: resident and non-resident. Only for, now let us look at the proviso. Only for, in case of a person who is not ordinarily resident, getting it? So that we will see later. So only for individuals or HUFs. Only for whom? Individuals or HUF. This middle category will apply. This middle category is for which type of taxpayers? If the taxpayer is individual or HUF. Now, only for individual and HUF, this kind of ROR, RNOR, this classification will apply. Suppose if the taxpayer is a company, only two categories: either company can be a resident or non-resident. Partnership firm, a partnership firm or LLP can be either a resident or non-resident. Getting it? Or a society can be a resident or non-resident. AOP or BOI, resident or non-resident, that's it. Only for individuals and only for HUF. We not only classify RNR, we have an in-between category RNOR. He's a resident, but not ordinarily resident. Now you see. So first rule, what are they saying? If an income is received in India, if the income is received in India, if you are receiving in India, we don't look at your residential status. We will tax it in all the cases. We tax it. Whether you are a resident, not ordinarily resident, non-resident, doesn't matter. We tax it. Okay, sir, I have not received in India, sir. Is the source in India? What do you mean by source in India? What do you mean by source? Is accrual in India? Is source in India? Suppose you are working for an Indian company. Source is in India because it's an Indian company. You have a property in India and renting it. Property situated in India. So source is in India. So if the source of income is in India, if the income is accrued or deemed to accrue or arise in India, then it is taxable for everybody. Whoever it is, doesn't matter. Non-resident, Indian citizen, foreign citizen, doesn't matter. Taxable for everybody. Suppose if the income is, source is outside. If the source is outside India, getting it? Suppose, no, very simple. How we apply this rule? No? First we will see, is the income received in India? Yes, taxable. No confusion. Sir, it is not received in India. Then second point, is the source of income in India? Sir, it is also not in India. Source of income is not in India. Then we don't apply these two. Then we will see third one. Is the source of income outside India? Yes, sir. Taxable for resident, not taxable for non-resident. For non-resident, it is not taxable if the source of income is outside India. If at all receiving is in India, it is again taxable. See, when I apply first rule, no. When we apply first rule, no. Is the income received in India? In the first rule, they are not asking us anything about source. Have you received in India so and so amount? Yes, taxable. That's it. Where is the source of income? We don't bother. Suppose you did not receive the amount. You have not received the amount in India. You received it abroad. Then what we will check? Okay, received abroad. Then from where you are getting this income? What is the source of this income? If that is in India, taxable. First, no, for a non-resident, we tax an income based on receipt. If it is not received in India, not taxable. If it is received in India, taxable. Not received in India. Then we apply for the non-resident second one. Is the source in India? Non-resident said yes, then taxable. Sir, source is also not in India. Received is not in India, source not in India. Then it is not taxable at all. Non-resident, it is not taxable. Income is not in India. Source, suppose, no, I am a US citizen, settled in the US itself. I am working in a company, in a US company. I am earning some monthly $10,000 or $500 or $1,000, whatever. Now, just ask him, hey, where are you earning this money? US. Source is outside. Where are you receiving that money? US only. Receipt is also outside. Why the hell you tax him in India? Simple. Very logical. For resident, no. For resident, no. For first category, for resident, no. In case of individuals, we simply call him as ordinarily resident. We simply call him as what? Ordinarily resident. For a resident, you see, every case it is taxable. Whether source is in India, receipt in India, source is outside, receipt outside, doesn't matter. Global income is taxable. You can make a note. You can make a note. Star mark, you put it. So for residents, in case of individuals and HUF, we use the word ordinarily resident. Global income is taxable. What is the logic? Global income is taxable. Getting it? So for resident and ordinarily resident, and for a normal resident, global income is taxable. Now, what about a resident but not ordinarily resident? He is a resident in the current year, but in the last 4 years, 3 years, 7 years, he is not a resident. This year only he came to India, and this year he became a resident. He is a resident, but ordinarily he is not resident. Ordinarily he is not staying in India. Only this year he is staying in India. What is resident and ordinarily resident? Resident and ordinarily resident. He is a resident in India for this year. Not only this year, ordinarily also in the last year also he stays in India only. Resident and ordinarily means he is a resident in India for current year, and even in the past also he is a resident. So he is ordinarily resident only. Suppose I am a foreign citizen. I came to India. This full year I stayed in India. This year I am a resident. But am I resident ordinarily? No. So we call him as resident but not ordinarily resident. See, we have a definitions for ROR, RNOR, NR. How to determine this? We have a full-fledged section. Section 6 we have. There we will discuss. Now what is taxable for RNOR? First what principle we'll see? Where you received the income? India. Taxable. Not received in India? Then we apply the second rule. Where is the source of income? India. Taxable straight away. Source is also not India. You have not received in India. Source is also not in India, and you are not ordinarily resident. You are residing only current year. Previously you are not residing in India. This year you are a resident. Previously you are not a resident. So you are a resident but not ordinarily a resident. For you, when an income is taxable, if receipt is outside, source is outside, everything is outside, but it is taxable only in one situation. If it is a business income, if it is a profession income, if it is a business income, profession income, controlled setup in India. If a business is outside India, you are having a business outside India, you are a resident in the current year only, getting it? You are not receiving any income in India, you are not earning any income in India, both are outside, receipt and source, both are outside, logically speaking not taxable, but only one type of income is taxable for you. Only one type of income is taxable, even though, what is it? Even though source and receipt both are outside. Which income is taxable even though source and receipt are both are outside? If it is a business income or a profession income. If it is a business income or profession, which business or profession? If it is a business controlled from India, profession set up in India, then it is taxable. Suppose I am a doctor. I went abroad and worked for past 15 years. I set up a big hospital. Now the hospital is top notch. Okay, even without my physical presence, it runs. So I took retirement and came back to India, settled here, enjoying with my grandchildren, all that. Every meeting for the hospital I will attend. Every meeting, virtually I will attend every meeting. Getting it? I am the chief of the hospital, always. Getting it? All key decisions I will only take. Now, I attend meetings virtually from sitting in India, right? Now, tell me, the hospital is outside India. Amount is received by the hospital from patients outside India, but it is controlled from India, indirectly by me. So, if it is a business controlled from India, if you are a resident but not ordinarily resident, it is taxable. Suppose, I am having shares in a company. Let us look at this situation, shares. In which company? United States. Apple company I'm having shares. And I have a bank account in United States also. I have a bank account with the Bank of America. There is a bank called Bank of America. In that I have a bank account, foreign bank account. So I purchased the shares of Apple Incorporation in the United States by using funds which are there in the Bank of America, and I purchased. And the company declared dividend. The dividend is directly credited to Bank of America, my foreign bank account. It is credited directly to my foreign bank account. Now tell me, if an income is directly credited to foreign bank account. Now, the question, I am an RNOR, I am not ROR, I am not ordinary resident. See, if it is ordinary resident, no discussion at all. Straight away taxable. Where you received, where you accrued, where you, that and all not relevant. Taxable. If it is RNOR, resident but not ordinarily resident, what we need to check? First, receipt. Second, source. Then, if both are outside, then we will see, is it business controlled from India? Is it profession set up from India? This we will check. Now, in this example, what I am taking, what is the income? Dividend income. Source is where? Apple company outside India. Where are you receiving? Outside India. Is it a business income? No, sir, it's a dividend income. Dividend income means income from other sources, not taxable. What is it? Not taxable. Why? Source is outside, receipt is outside. So, from this, what are the rules that we can frame? First one, if an income is received in India, always taxable for all categories of SSCs. Suppose if it is not received in India, then we will check accrual. Is income accrued in India? Yes, it is taxable. If the income is accrued in India, taxable. Suppose income is not received, income is not accrued. For a resident and ordinarily resident, it is always taxable. For resident but not ordinarily resident, only business income, profession income, set up or controlled from India, only this is taxable for R&O. And if it is a non-resident, sir, I am a non-resident, sir. I have a business, I have a hospital in United States. I just came for a visit in India. In between, I attended meeting and took a decision. I am a non-resident. How the come you can tax me? I am not sitting in India. I am not staying in India for long. I just came for 10 days visit. During this 10 days, my hospital has some important decision. They called me over phone. I attended the call and I replied. And further, you tax me? No. So that's why for a non-resident who don't stay in India, getting it, who don't reside in India normally, getting it, for him, we don't tax even if it is business, even if it is profession. For resident but not ordinarily resident, if a business is situated outside India, profession is situated outside India, if you are controlling it from India, it is taxable. For resident only, it is taxable. I hope you are clear. Now you see, there is a clarification given. There is a clarification given on a particular thing. Just a minute. Yes, next. Now, there is a clarification given by CBDT. What are they saying? They have given a circular. Liability to income tax in India. It's regarding taxability in India for whom? Non-resident seafarer. A non-resident seafarer receiving remuneration in NRE account maintained with an Indian bank. Any income by way of salary received by non-residents for services rendered outside India on a foreign ship but received in NRE bank account shall not be included in total income. Shall not be. The question, he's actually a non-resident, no? So non-resident earning salary from foreign shipping company. Some foreign shipping companies, sir, salary is paid to non-resident fellow, sir. But this non-resident is having bank account with what? He is having bank account with the Indian bank. Indian bank means not bank name, Indian bank. Indian bank means a bank registered in India. That's what Indian bank means. This Indian bank can be State Bank of India, ICICI Bank, HDFC Bank, all this. With these banks, this non-resident has an account called NRE account. In this account, his salary amount from foreign shipping company is credited. Is this taxable? Do we call it as received in India? Do we call it as received in India and tax it? No. Circular says it is not taxable. Now, first of all, sir, what is this NRE account? We know savings account, current account, fixed deposit, recurring deposit. What is NRE? Yes, there are, there is a law called FEMA. There is a law called FEMA. What FEMA says is, a foreign and a non-resident, it's about non-resident, a non-resident, getting it, is prohibited. A non-resident is prohibited to hold a regular savings account or current account with any Indian bank. Yes. A non-resident is prohibited to hold a regular savings account or current account. You're not a resident in India. Okay, why you need a bank account in India? Sir, but I stayed all these years as a student in India. Sir, I studied in India. My parents are in India. Just for job purpose, I am going abroad. How come you ask me to close all my bank accounts all these days which I have? Open. I'm not asking you to permanently close. Open NRE, NRO accounts. What is it? Instead of normal savings account, normal current account, open NRE, NRO. So those who are leaving India, those who are settling for jobs center outside India, if you want to send money to your parents sitting in India, don't use your personal savings account. Don't take any savings bank account within India. You open special accounts called NRE, NRO. What is NRE? NRE means non-resident external account. NRO means non-resident ordinary account. Non-resident external account, non-resident ordinary. In a non-resident external, you are a non-resident opening a bank account with India. So it's a non-resident related bank account. It's a non-resident related bank account. Now, which account is this? It's an external account. External means what? Whatever incomes you are earning externally, whatever incomes that you are earning, not in India, but outside India, external income, you can transfer all that income to NRE. You can transfer. Remember, whether it is NRE or NRO, in both these cases, the balance will be visible in rupees only. The balance is shown in rupees only, not in dollars or something. You are receiving amount in dollars. The moment it credits to NRE bank account, it turns into rupees at exchange rate. Okay, so you can receive entire foreign income in NRE. Suppose you have property in India. You are an Indian citizen earlier. You have a property in India. Somebody is paying rent. Don't take it in NRE. That is prohibited. In NRE, you can only take foreign income. Okay. Now you are taking foreign income to India. No, is it treated as received in India? A non-resident receiving income in NRE, especially a seafarer, non-resident seafarer working in a foreign ship. Getting it? If at all he is receiving salary, it is received in NRE account, which is a bank account in India. It's actually received in India, but the circular says not taxable. The circular says it is not taxable. That's what the circular actually pointed. So NRE means only foreign incomes you can send back. Now NRE amount, you got some money, no? Can you send it back to foreign country, some other bank account? If you want to, you can happily. Whatever amount is there in NRE, getting it, you can repatriate to another bank account in your foreign country, or you can send that money to NRE. We call this as repatriation. What is it called as? Repatriation. Repatriation means what? You are getting some money from foreign. That money can be deposited in NRE. From NRE, you can transfer back that money. Both these called as inward-outward repatriation. What is NRO? In NRO, you are getting foreign income. You can receive directly that into NRO. You can receive foreign income can be received in NRO. Not only that, Indian income also can be received in NRO. Suppose locally you have a some house property. That person want to pay rent. You can collect it in NRO happily. In NRO, you can collect domestic income as well as foreign. Both incomes you can collect in NRO. But the problem is, for NRO account, you cannot transfer from NRO to another account beyond a particular limit. There is a limit on this. In NRO, whatever amount you are getting, whatever amount is there in NRO, you want to transfer it beyond $1 million in a year. Per year, some $1 million, something is there, or $1 lakh, some limit is there. Beyond that, you cannot transfer. Whereas NRE, no limits. For NRE, no limits. Now tell me, whether it is NRE or NRO, both are bank accounts. No? When I am having a bank account, when I maintain balance, bank will give interest, yes or no? Now, if I get any interest amount, in NRE outstanding balance, in my NRE account, if I am getting any interest, exempt. Whereas NRO account, if I get any interest from bank, it is taxable. From NRO, if I am getting any interest income, it is taxable. Getting it? NRO means it's an account maintained with an Indian bank by a non-resident. Both are non-resident related bank accounts only. One is ordinary account, another one is external. Ordinary means just like any savings account. So in this, you can receive foreign money, Indian money, whatever. Whereas external, only external money you can receive. So that's what the difference between NRE and NRO. And remember, as per FEMA, a non-resident cannot maintain a bank account in India. He should not maintain that. That's it. Okay. So that is regarding this particular circular. Now there is an illustration, illustration 5, and there is another illustration, illustration 8. Both these illustrations are talking about scope of total income related problem only. So we will straight away solve. Illustration 5 is very easy. I will solve illustration 8, which is very big. Okay, so can we directly go and solve illustration number 8? Yes. So look at this illustration 8. You see, they're asking you, compute the total income in the hands of an individual 35 years being a resident and ordinarily resident, means global income is taxable. He is a resident but not ordinarily resident. He is a resident but not ordinary resident and non-resident. So which means they're asking, they are giving list of incomes. They are giving so many incomes here and they're asking you, please compute tax. Case 1, if he is a non-resident, how much of this is taxable? Non-resident, how much is taxable? Resident and but not ordinary resident, how much is taxable? Very simple. Now tell me. So now let's look at how it is taxable. Now first one, now let us do one numbering. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. Yeah, totally we have 19 incomes. Totally we are having 19 incomes. I'm just giving serial number for better understanding. Now, first point is what? Interest on UK development bonds. So UK development bonds means what? Source of income is outside India. Source of income is outside India. Okay, fine. Anyhow, 50% is received in India. They are saying 50% is received in India. Right now, don't consider double taxation, all that, ignore all that. I just gave you for your understanding of how residential status works across the world. Getting it? Fine. 50% is received. Now tell me, let us open, this one. So point number 1. So resident and ordinarily resident, resident but not ordinarily resident, non-resident. Now tell me, for non-resident, what is taxable? Received in India or source in India? Only then it is taxable. Even for ordinary resident, only even for resident but not ordinarily resident, either received must be in India, source must be in India, or if both are outside India, it must be business or profession controlled from India. Then only it is taxable. For resident and ordinary, global income is taxable. Source where received doesn't, that and all doesn't matter. Global income. This is the rule. So based on this rule, we will evaluate now. So income from UK development bonds, source is outside. Received how much? 50%. What is the gross? 10,000. How much is received in India? Only 50%. For a non-resident, only if it is received, it is taxable. No, 50% means what? 5,000. Even for resident but not ordinarily resident also, if the income is received in India, only taxable. Source is outside. Received in India, taxable. Source in India, taxable. If source is outside, business only taxable in India. Now in this example, source is outside, but received is in India. Now how much is received? 50%. Only 50% is taxable, 5,000. Now for ROR, whether source is in India or outside India, global income is taxable, which means how much is the amount? 10,000. Correct? Next, second one. Income from business in Chennai. 50% is received in India. Now tell me, when the source is in India, should I bother about where it is received? No need. Income itself is in India. Whether you are a non-resident, resident, doesn't matter. Straight away, entire 20,000 is taxable for all. Second one, 20,000 is taxable for everybody. Yes or no? Then third one, short-term capital gains. Okay. On sale of shares of Indian company, again source is in India. It's an Indian company, that shares you sold and you got some profit, which is again 20,000. Indian company shares, source is in India. Obviously taxable for everybody. Taxable for everybody. Again another 20,000. Fourth one. Next. Long-term capital gain on sale of plant, some machinery at Germany. Source is outside. Source is outside. First, what we should check? Where it is received, we should check. Where it is received. 50% gains are received in India. Only 50% is received in India. That means out of 40, 50% only taxable for non-resident. For your better understanding, these are actually the rules like this, Just a minute. First, when you are solving, always. First rule, apply source rule. First apply always source rule. If source is not in India, then check where it is received. That is second rule you apply. receipt is also not in India, then third rule will apply. So whatever third rule says, that will follow. So first we should apply source rule, then we should apply receipt rule, then we should apply the final residuary rule. That's it. Now the source is in Germany. So if the source is in Germany, generally it is not taxable. Then we should apply which rule? Receipt rule. How much is received in India? 40,000. Remember, sorry, 50%. 50% means again 20,000 and 20,000. Remember, for ROR, global income is taxable. 40,000 is taxable. What is it? 40,000 is taxable. Next another. Income earned from business in Germany, which is controlled from Delhi. Oh my God. Income is earned from Germany, controlled from Delhi. Only 40,000 rupees is received in India. Remember how much is received in India? 40,000. Now this point generally many students confuse. Yes. So this point generally many students confuse. So what is it? What is the total actual that income from Germany? 70. Where is the source? Germany. Where it is received? Only 40,000 is received in India. Remember, for a non-resident, only if the income is received in India or source is in India, only these two taxable. If source and receipt both are outside, not taxable. Now tell me, in this case, for a non-resident, for a non-resident, how much is taxable? Only 40,000 which is received in India is taxable. Yes or no? Actually, entire source is outside. Only 40,000 is received in India. Only received in India is taxable. Now look at R and OR. R and OR. What is R and OR? For R and OR, if the source is outside, but if it is a business controlled from India, fully taxable. For R and OR also, for non-resident and resident but not ordinarily resident, for both of them are rule is same. Either it should be, source should be in India or receipt should be in India. Both are outside, not taxable. But for R and OR, only one exception is there. What is that exception? From business or profession controlled or set up from India, then only for R and OR it is taxable. So for R and OR, entire 70,000 is taxable because it's a business controlled from Delhi. And for resident and ordinary, global income is taxable, no rule at all. Once again, I'll tell you the rule. For a resident and ordinarily resident, global income is taxable. Rule number 1. So where the source is in India, whether the source is outside India, whether received in India, received outside, doesn't matter, taxable. General rule. Second one, for a non-resident and resident but not ordinarily resident, for these two categories, income is taxable. Point number 1, if source is in India, taxable. No, receipt in India, taxable. Third one, for R and OR only, for R and OR only, even though the source is outside, even though the receipt is outside, but if it is from a business controlled from India, if it is from a profession set up in India, taxable. Generally, if it is a non-resident, no, business is outside, profession is outside, controlled from India, if you are a non-resident, not taxable at all. Only for R and OR it is taxable. Yeah, sorry for the interruption. Yes. So I hope you understood this summary point. Next, 6th point. Income from business in Delhi. Source is in India. Straight away, no need to look at where it is received. Straight away taxable for all. What is the income? 15,000. 6th one. 15,000. 15,000. 15,000. And 7th one. Income from house property in London. Source is outside. If source is outside, wherever it is, how much is the income? 50,000. For a resident, it is straight away taxable, no? 50,000. But you know, from house property, no? For house property, we have a chapter. There's something called 30% exemption. 30% reduction is there. Whatever rent you are getting, out of it, 30% is exempted. So let us tax 50% minus 30%. So 50,000 minus 30%, which will be 35,000. Okay. I am taxing net income as per income tax rule. Just sir, what is this 30%? All that, don't worry, we will discuss that in next chapter. So he is getting how much rent? 50,000 minus house property deduction is how much? 30%. That's it. So that's fine. Fine. Anyhow, let us go back. Deposited in bank at London. What is it? Deposited at bank at London. Brought to India. What is it? Brought to India. It's an income. Properties in London. Source is outside. Brought to India means that cash is brought to India. Now, does it mean received in India? No. Remember, the tenant deposited in your bank account which is there in London. You are having a bank account in London. Okay, some particular bank you are having. Inside the tenant deposited money. Where it is received? In London only. Now you may say, sir, it is brought to India. No, received. No. I am not receiving in India. I am just transferring from my bank account in London to bank account. It's a transfer. That's it. It is not received. Did he deposit directly to my bank account situated in India? If I received in India, received means what? What do you mean by received? Received means first time where are you receiving it? First time when the amount is getting into your control. Getting it? So it is deposited in London means property source is outside. First time that money you received it outside only. You didn't receive it in India. You received it in India. It is coming into your control outside itself. So for R and OR and NR, for R and OR and NR, not taxable. It is not taxable. So next one, eighth one. I hope you understood. Received in India means first time income is coming under your control. If at all that is coming into your control outside itself, that means received outside. First receipt, where it is received for the first time, that is what important. Next, interest on debentures in Indian company. Debentures in Indian company means source in India, always taxable for everybody. So the answer is taxable for everyone. How much is that? 12,000. 12,000. 12,000. Then fee for technical services rendered in India. Services provided in India but received in London. Where you receive it doesn't matter. Source is in India. So taxable for everybody. So source is in India. Therefore it is taxable for everybody. 8,000. 8,000. 8,000. So ninth one is also over. Still 10 more were there. Oh my God. You will not have this much time in exam. I am just explaining you each point. Why? Because one time if you solve this problem and understood how to apply that principle, that's it. Next, profit from business in Mumbai. Business is in Mumbai. Source is in Mumbai. Taxable for everybody. 26,000 is taxable for everybody. 10th item. 26,000. 26,000. 26,000. That's it. Next, 11th item. 10th one complete. 11th one. Income from property situated in Nepal. Source is outside. Received there. Received also outside. For both of them 0, 0. But for non-resident, but for resident, global income is taxable. 16,000 is taxable. For this category, no. For first category, no. Always taxable. All incomes are. 12th one. Past foreign untaxed income. Past foreign untaxed income brought to India during the previous year. This is not current year income. That is past year income. That will be taxable in that assessment year itself. In this assessment year, it is generally not taxable. If any past untaxed foreign income is there, that is brought to India, there is no provision in the income tax law taxing that. Getting it? So resultantly, it is not taxable for anybody. It is not taxable for anybody. Not taxable, not taxable, not taxable. For anyone, it is not taxable. Because it's a past income. This is not current year income. This is not assessment year 23-24. Previous year 22-23. That is not that income. It is past year income. Past year income is taxable in that year only generally. But in India, there is no provision for taxing that type of income. 13th one. Income from agricultural land in Nepal. Received there. Brought to India. Received is also there. Later brought to India doesn't matter. Where it is first received important. Source outside, receipt outside. Not taxable for non-resident and R and OR. Not taxable, not taxable. But for this fellow it is 18,000. But for this fellow 18,000 is taxable. 14th item. Next. Income from profession in Kenya. Source outside. Set up in India. Set up in India means it's controlled from India. That's what the meaning is. Okay. Set up in India. Received there but spent in India. You are receiving. Source is outside. Receiving outside. But you are spending that income in India. Doesn't matter. For non-resident it is not taxable. For non-resident it is not taxable. But for remember, For resident, global resident, entire, I mean, resident global income is taxable. Even for RNOR, if it is a business or profession set up or controlled from India, taxable. So here also it is taxable. If at all any of you have guessed it correctly, very good of you. Gift received on the occasion of wedding. Like there is a provision in other sources chapter. Any gift that we are receiving on wedding is exempted. Okay, for everybody it is exempted. 15th point, not taxable, not taxable, not taxable. 16th point. 16th point. Interest on savings bank account deposit in State Bank of India. It says interest amount, that too bank account is in India, savings bank deposit with State Bank of India, source is in India, taxable for everybody. What is it? Taxable for everybody. 12,000, 12,000, 12,000. No, there is a provision, ATTTA, there is a section which we will discuss in chapter 6a. What it says is, interest on savings account is deductible up to 10,000 rupees. Up to how much? 10,000 rupees you will get a deduction. That we will discuss later. Okay, at the end of the problem, we will reduce that. Okay, you see, here also it is adjusted. Here also deduction under ATCCA, 10,000, 10,000, 10,000 will be adjusted. So that's a benefit which is given for all the interest savings account. 17th item. 17th item. Income from business in Russia, controlled from Russia. Receipt point they didn't given. So assume that it is received in Russia. Okay. So source is outside, receipt is outside. So 20,000 is taxable only for resident and ordinarily resident. So not taxable, not taxable. 18th one. 18th one. Dividend from Reliance Petroleum, Indian company. Indian company, no. Taxable for all. Source is in India. So taxable for all. So 19th one. Agricultural income from land in Rajasthan. Agricultural income from a land situated in India is exempt for everybody. 10 subsection 1. So for exempt for everybody. Not taxable, not taxable, not taxable. That's a provision, ma. 10 subsection 1 provision. We have not yet discussed. We will discuss later. So total it. Total it. From the total what we are getting, reduce 10,000 for everyone. Reduce 10,000 for everyone. Sir, why are we reducing? Sir, you didn't explain. This is because of ATTTA deduction. Now we have the savings interest, right? 12,000, 12,000, 12,000. Any interest on savings deposit is deductible up to 10,000 from gross total income. So what is gross total income? You total it. You will get some money, right? From that, you reduce this, then you will get the final answer. This is the answer for the 8th illustration. Now I request you to solve 5th illustration, which is only 4 or 5 adjustments, a small illustration. 5th illustration. 8th big one I solved, no. 5th illustration, which is small and medium one, you solve it. That's it. With this, part 2 of this chapter is completed. So what we understood is, every country will tax on first one, source based. If the source is not in that country, then receipt based. If receipt is also not in that country, then generally they don't tax. But for residents in that country, they tax global incomes. Same way in India, a resident, global income is taxable. In case of individual, ordinarily resident, global income is taxable. Non-resident, source should be in India or receipt should be in India. If both are outside, not at all taxable. Any income not taxable. Resident but not ordinarily resident. Source should be in India, taxable. Receipt should be in India, taxable. Both are outside. Only one income, even though both are outside, even though source and receipt both are outside, only one income. Business and profession set up or controlled from India is taxable. That's it. There ends section 5. So with this, part 2 section 5 is completed. This entire section is completed. So in the next class, we will then discuss about how to identify residential, how to determine residential status. We will continue in the next session. I hope until now you understood clearly and thoroughly. That's it. So put it as a comment on the YouTube if you find this video. Just have you understood in a different perspective this particular topic. So hardly another 3 hours or 4 hours, this chapter will be completed. Okay. Take care.